What is crypto? Welcome to Money and Good Sense. Bitcoin, Ethereum, and other cryptocurrencies have become a global phenomenon over the past few years. Some people see crypto as the future of money, while others view it mainly as a speculative investment. Opinions differ wildly, but many people still do not really know what cryptocurrency actually is. Where did crypto come from? Why was it created? How does it work? And why are some people willing to pay enormous amounts of money for it? In this video, we will explain step by step what cryptocurrency is, how it works, why it was created, and how it differs from traditional money. We will do this in a calm and easy to understand way without using complicated technical language. Along the way, we will look not only at the opportunities crypto offers, but also at its limitations and risks. So let's start with the basics. What exactly is cryptocurrency? Cryptocurrency, usually shortened to crypto, is a form of digital money. Unlike the US dollar, crypto does not exist as physical coins or paper bills that you can keep in your wallet. It exists only in digital form. One of the biggest differences between cryptocurrency and the traditional money is that most cryptocurrencies are not issued by a central bank or a government. With the US dollar, the money supply is managed by the Federal Reserve. With many cryptocurrencies, however, the rules for creating and distributing new coins are built directly into the computer network. The best-known cryptocurrency is Bitcoin. In addition, there are thousands of other cryptocurrencies, such as Ethereum, Solana, and XRP. Although they all fall under the general term cryptocurrency, they do not all serve the same purpose or have the same characteristics. Some people use crypto to make payments, but many others buy it as an investment, hoping its value will increase over time. It is also important to understand the difference between cryptocurrency and the US dollar. The US dollar is official legal tender in the United States. That means you pay taxes in dollars. Most people receive their salaries in dollars. And almost all everyday transactions are made using dollars. Cryptocurrencies work differently. Whether you can use them to make a payment depends entirely on whether the other party is willing to accept that particular cryptocurrency. In short, cryptocurrency is digital money that can operate without a central bank, but it differs in several important ways from the money we use in our daily lives. Why was crypto created? To understand why cryptocurrency was created, we first need to go back to the financial crisis of 2008. During that period, many banks around the world faced serious financial problems. Some banks went bankrupt, while others could only survive with billions of dollars in government bailouts. As a result, many people lost part of their trust in the financial system. At the same time, people began asking whether it would be possible to create a form of digital money that did not depend on a bank or a central authority. A system that would allow people to send money directly to one another without needing a bank as an intermediary. On October 31, 2008, a document was published online describing a new digital payment system. The author used the name Satoshi Nakamoto. To this day, no one knows whether Satoshi Nakamoto is one person or group of people. His, her, or their true identity remains one of the greatest mysteries in the financial world. A few months later, in January 2009, the first cryptocurrency was launched, Bitcoin. The idea behind Bitcoin was simple, yet revolutionary. Instead of relying on a single bank to verify every transaction, a network of thousands of computers around the world would work together to confirm whether a payment was valid. As a result, there is no central authority that controls the system or decides to create more Bitcoins whenever it wants. This is known as a decentralized system. The network is not controlled by a single bank, a single company, or a single government, but by all of its participants working together. Since the introduction of Bitcoin, thousands of other cryptocurrencies have been developed. Some are very similar to Bitcoin, while others were designed for entirely different purposes. Even so, the idea of a digital, decentralized network remains the foundation of most cryptocurrencies today. How does crypto work? Now that you know why cryptocurrency was created, the next question is, how does it actually work? The technology behind almost all cryptocurrencies is called the blockchain. The best way to think of a blockchain is as a digital ledger. This ledger records every transaction that takes place. Whenever someone sends or receives cryptocurrency, that transaction is recorded in this digital ledger. Unlike a traditional bank account, this ledger is not stored on a single computer or at a single bank. Instead, it is stored simultaneously on thousands of computers connected around the world. Each of these computers keeps an identical copy of the ledger. When someone sends a payment, the network first verifies that the transaction is valid. For example, it checks whether the sender actually owns the cryptocurrency and whether those same coins have not already been spent. Only when the network agrees that the transaction is valid, it is added to the blockchain. From that moment on, the transaction becomes part of the shared ledger. Because thousands of computers store the same information, it is extremely difficult to alter the blockchain afterward. Someone would have to change not only just one computer, but a large part of the entire network at the same time. That makes fraud much more difficult. To use cryptocurrency, you need a digital wallet. You can think of a wallet as a digital version of your physical wallet. It does not actually store the coins themselves. Instead, it stores the digital keys that prove your ownership of a specific cryptocurrency. These keys allow you to receive and send cryptocurrency. Let's look at a simple example. Suppose John wants to send 1 Bitcoin to Lisa. John opens his wallet and instructs it to send 1 Bitcoin to Lisa's wallet. The network then verifies that John actually owns that Bitcoin and has not already spent it. If the transaction is approved, it is added to the blockchain. After that, Lisa sees the Bitcoin appear in her wallet. No bank is involved in the process. The verification is carried out by the network itself. That is the basic principle behind how cryptocurrency works. What is crypto used for? Now that you know how cryptocurrency works, the next question is, what is it actually used for? The most well-known use is sending money. Cryptocurrency allows people to transfer money directly to one another anywhere in the world without needing a bank as an intermediary. In some cases, this can be faster and less expensive than a traditional international bank transfer. Even so, cryptocurrency is still used relatively little for everyday purchases or paying bills. In the United States, most stores, businesses, and the government agencies still accept only US dollars as a means of payment. As a result, many people do not use crypto as a replacement for their bank account, but for other purposes. Another major use is investing. Many people buy cryptocurrency because they expect its value to increase over time. Like other investments, they hope to sell it later at a higher price. However, because cryptocurrency prices can fluctuate dramatically, investing in crypto also involves significant risks. Some cryptocurrencies can do much more than process payments. A good example is Ethereum. This network makes it possible to run so-called smart contracts. You can think of a smart contract as a digital agreement that automatically executes once predetermined conditions have been met. In certain situations, this removes the need for a notary, a bank, or another intermediary to carry out an agreement. In addition to payments and smart contracts, cryptocurrencies are now used for a wide range of financial applications, including international commerce, digital assets, and new online services. The possibilities continue to evolve. However, it is important to understand that cryptocurrency is still not a universally accepted means of payment. Whether you can pay with crypto depends entirely on whether the recipient is willing to accept it. As a result, cryptocurrency is still used far more often as an investment than as an everyday means of payment. How are bitcoins created and why do they have value? Now that you know what cryptocurrency is, why it was created, how it works, and what it is used for, one important question remains. How are bitcoins actually created? With the US dollar, the Federal Reserve controls the money supply. Bitcoin works differently. There is no central bank that can simply create new bitcoins whenever it wants. New bitcoins are created when computers around the world perform complex calculations to verify transactions and add new blocks to the blockchain. This process is known as mining. The computer that successfully adds a new block to the blockchain first receives a reward in the form of newly created bitcoins. That is how new bitcoins gradually enter circulation. What makes Bitcoin unique is that the maximum number of bitcoins that can ever exist was determined in advance. That limit is 21 million bitcoins. As a result, no one can create an unlimited number of new bitcoins. As more bitcoins are issued, the reward paid to miners becomes smaller over time. As a result, new bitcoins enter circulation at an increasingly slower pace. Not all cryptocurrencies work this way. Bitcoin uses mining, while other cryptocurrencies rely on different methods to verify transactions and bring new coins into circulation. Now that we know how bitcoins are created, the next question is why people are willing to pay for them. Like many other assets, the price of Bitcoin is determined by supply and demand. When many people want to buy Bitcoin and only a limited number of Bitcoins are available, the price will generally rise. When many people want to sell, the price will usually fall. Trust also plays an important role. The more people believe that Bitcoin will remain valuable or become more widely used in the future, the greater the demand often becomes. The limited supply of 21 million bitcoins is another important factor. Many people see this scarcity as one of the reasons why Bitcoin may be able to preserve its value over time. However, scarcity alone is not enough. Without demand, even a scarce asset has little value. News events and government regulations can also have a major impact on the price. Positive news can increase demand, while negative news or stricter regulations can lead to significant price declines. That is why cryptocurrency prices often fluctuate much more than the prices of many other investments. Ultimately, the value of Bitcoin and many other cryptocurrencies is determined by what buyers are willing to pay and what sellers are willing to accept. That is why it is important to understand that investing in cryptocurrency involves significant risks, because sharp price increases can often be followed by equally sharp declines. How does crypto differ from money and other investments? Now that we know what cryptocurrency is, how it works, how bitcoins are created, and what determines their value, we can compare cryptocurrency with money and other investments. This is where the most important differences become clear. The US dollar is the official legal tender in the United States. You can pay everything with US dollars, and everyone is obligated to accept it. Cryptocurrency works differently. When you can pay with crypto depends entirely on whether the recipient is willing to accept it. Its acceptance is therefore largely voluntary. That does not mean cryptocurrency cannot have value, but it does mean that it serves a different role from money we use every day. Cryptocurrency also differs from many other investments. If you own a rental property, you may receive rental income. If you own shares of a company, you may receive dividends when the company distributes part of its profits. If you own a bond, you will generally receive interest according to the terms of the bond. These investments can therefore generate income in addition to any increase in value. With many cryptocurrencies, the situation is different. Your return usually depends on changes in the market price. If the market price rises, you make a profit. If the market price falls, you may incur a loss. In other words, your return often depends on what the next buyer is willing to pay. That is why it is important to look beyond the price itself and ask what gives cryptocurrency its value. Why do people believe this cryptocurrency could become more valuable in the future? Where does the demand come from? What purpose does it serve? And how sustainable is that demand over the long term? Those are the questions every investor should ask. The same principle applies to every other investment. The better you understand where value comes from and what drives an investment's potential return, the better you can assess both its opportunities and its risks. That is ultimately far more important than simply hoping the price will continue to rise. Benefits and risk. As you have seen, cryptocurrency offers several advantages, but it also comes with important risks. That is why it is important to understand both sides before deciding whether to use or invest in cryptocurrency. One important advantage is that cryptocurrency can be used worldwide. Payments can be sent directly from one person to another without requiring a bank as intermediary. As a result, international transactions can, in some cases, be faster and less expensive. In addition, the technology behind cryptocurrency has made many new innovations possible. Examples include smart contracts and other digital applications that can operate without central authority. However, these advantages also come with clear risks. Cryptocurrency prices can rise sharply in a short period of time, but they can also fall just as quickly. As a result, investors can make substantial profits, but they can also suffer significant losses. In addition, scammers regularly try to take advantage of crypto's popularity. Fake investment platforms, phishing scams, and other forms of fraud are unfortunately still common. Safely storing cryptocurrency also requires personal responsibility. If you lose access to your wallet or security credentials associated with it, your cryptocurrency may be lost permanently. Governments can also introduce new laws and regulations. Changes in regulation can affect the use, trading, and value of cryptocurrencies. Finally, there is no guarantee that cryptocurrency will become more widely accepted in the future. Its long-term development will depend on technological progress, government regulation, and, above all, the confidence people continue to have in it. That is why it is wise not to focus only on the potential rewards, but also to carefully consider the risks. A good investor does not look only at the opportunities, but also understands the risks before making a decision. Conclusion. You now know what cryptocurrency is, why it was created, how it works, and what it is used for. You also have seen how new bitcoins are created, what determines their value, and how cryptocurrency differs from traditional money and other investments. The technology behind cryptocurrency is innovative and offers many possibilities. At the same time, investing in cryptocurrency involves risks that should not be underestimated. Whether cryptocurrency will play a larger role in the future is something no one can know with certainty. That will depend on technological developments, government regulation, user adoption, and, above all, the confidence people continue to have in it. After watching this video, you may now decide to invest in cryptocurrency, or you may decide that it is not for you. Both decisions can be wise as long as they are based on knowledge rather than emotion or unrealistic expectations. The purpose of this video was never to convince you to either invest in cryptocurrencies or to avoid it. Its purpose was to help you understand how cryptocurrency works so that you can make an informed decision for yourself. Because the better you understand what you are investing in, the less likely you are to make decisions that you may later regret. For now, I thank you for watching. And as always, don't worry too much. Everything can be overcome with study and patience.